Good afternoon, everyone. I'm Vaishnavi Vaiti from Kirin Advisors. Welcome to the virtual roadshow of Anlon Healthcare Limited. Today, we will provide a brief overview of the company and its innovative business model. Anlon Healthcare Limited is a chemical manufacturing company engaged in producing high purity advanced pharmaceutical intermediates used as raw materials in manufacturing active pharmaceutical ingredients and API used in finished dosage forms like tablets, capsules, syrups, and also in nutraceutical personal care and veterinary products. From management team, we have Mr. Puneet Kumar Sadia, Chairman and Managing Director. Good afternoon, Puneet sir. Welcome.
Good afternoon, Vaishnavi.
From Interactive Financial Services Limited, we have Mr. Mayur Parekh, Director, and Ms. Jenny Jain, Compliance Officer. Good afternoon, Mayur sir. Good afternoon, Jenny ma'am. Welcome. Now I hand over to Puneet sir to tell us the journey of the company. Over to you, sir.
Yeah, thank you, Vaishnavi. So, good afternoon, everyone, and I welcome to everyone on this virtual roadshow of Anlon Healthcare Limited. It is about the IPO, which is open tomorrow for all the investors. Anlon Healthcare is based in Rajkot, chemical manufacturer who is mainly deal with the pharmaceutical intermediate and bulk drugs like the active pharmaceutical ingredient. Our products are mostly used for the finished dosage for tablet, capsule, ointment, syrup, etc., which is going to used as a personal care, veterinary, nutraceutical products. Our products is complying with the almost all global pharmacopoeia standard, and along with that, our facility is approved with most of the regulatory approvals from the PMDA Japan, Anvisa Brazil, NMPA China, WHO India, and along with that, EU and US FDA compliance facility we are having with us. We are right now working with most of the globally 15 countries, and till the date we have 65 commercial product with us, 28 product at the pilot stage and 49 at the laboratory stage. Next. Vishnavi, can we start the presentation?
Yes,
Yeah.
sir. We'll start
Yeah.
with the presentation.
So, as everyone is seeing on the screen, the brief for the Anlon Healthcare Limited, as I mentioned, that we are mainly working with the pharmaceutical intermediate and bulk drugs. Next. Company is established in 2013 with the Anlon Venture Private Limited with the motive to acquire for any chemical manufacturer in which we can manufacture our intermediate and API. But after that, in 2015, we have changed the name of the company from Anlon Ventures Private Limited to Anlon Healthcare Private Limited. Company has started commencement of their own manufacturing facility, and it has been completed by 2018, and commercial production is started in by mid of 2018. Till the date total, we are having 142 products portfolio, in which out of that 65 products are already commercialized, 21 at a pilot stage, and 49 at the laboratory stage. We have filed approx 21 DMF, and some DMFs are already in pipeline. We are already working globally more than 15 countries. We are having the facility in Rajkot, which is spread across for more than 5,000 square meters area. Our total installed capacity for the production of intermediate and APIs approx 400 metric ton a year. We are having the mostly all the regulatory approvals in which the Brazil Anvisa, Japan PMDA, China NMPA, WHO GMP, with the strength of 105 employees, and we have worked mainly with the all these product mixture, and these products are be used for domestic as well as export customer. Next. From the management team, Mr. Meet Vachani is whole-time director who is having the 11-year experience with the initially pharma for its dosage formulation, distribution, and all those things. Mamta Rasadia is a non-executive, non-independent director of the company. Mr. Kannapalli Krishna Murthy ji is an independent director who has worked with as a finance controller in Kedila Pharma. Mr. Sailesh Thakkar is a non-executive independent director who is having the vast experience in the cosmetic as well as pharmaceutical finished dosage manufacturing. Anand Katkoria was the DGM at earlier known as the Corporation Bank, and he is also having the experience in the banking sector more than 20 years. Next. Company is having the product portfolio which is diverse in many therapeutic category. Mainly we are working with the pain management segment in which specifically non-steroidal anti-inflammatory drugs like ketoprofen, dexketoprofen and loxaprofen is our key product, and we are one of the largest and leading manufacturer for this product globally. Apart from that, company is having the portfolio with some of the cardiac, analgesic, antipyretic, antidepressant product with the nutraceutical product range with more than 20 nutraceutical APIs, which is the most emerging market nowadays. Along with that, we are having the some of the veterinary product and some of the cosmetic intermediate with us. Next. Company is having the different kind of portfolio along with in which pharmaceutical intermediate API, nutraceutical API, personal care intermediates, which is in going in the cosmetic product and veterinary API product. We have the bifurcation of the product with the, as I earlier mentioned, the 65 commercial product, then 49 at laboratory stage and 28 at pilot stage. Last 3 years, we have supplied the intermediates for our API manufacturer. Last year, FY25, the contribution was around 40%. For the finished FDF customer, our API contribution was around 53 percentage. For nutraceutical product, we have supplied last year around 6% from the total sales, and for personal care and veterinary, it was just started, so it was 0.01%. The manufacturing, considering our manufacturing capacity, the factory is located in the freehold land, which is around 22 kilometers from the Rajkot city, with the total installed capacity of 400 metric ton a year. We are the zero liquid discharge facility with the in-house effluent treatment plant and multi-effect evaporator with the 60,000 liter a day capacity, with 4 in-house laboratory for the testing and development for a new product, new process, optimization, cost cutting. We have mixture of the equipment for the multiple. We are considering as a multi-purpose plant for manufacturing of the any of the chemical product, with most of all these filtration, drying and other equipment in-house only. Our capacity utilization in last 3 years, FY23, it was around 79%. FY24, it was 38.25%. Last year, capacity utilization was at 84%. Next. So there are some glimpse of the facility which are having the two separate block for intermediate and API block with the two different clean lines. So two API production can go simultaneously. Next. We have been audited by around 33 customers all around the world, and we have not received till the date any major or uh, 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 major observation, or most of the regulatory audit we have received, that most of audit has been approved and no any critical observation till the date. Company has received the ISO compliance with the local GMP and local WHO GMP as well. Then now we are planning for the further expansion to extend our capacity from 400 metric ton to new facility with the 700 metric ton per annum. So totally 1100 metric ton a year. And the product what we are planning right now, it's in intermediate and APIs for the pharma as well as nutraceutical product both. Company is having next. Mainly, we are focusing on the research-driven development in which we are having the upper end and less dependency on any import material. So we are trying to develop the technologies and product from the indigenous material. So we can get the product which is suitable in the global strategy China plus alternative. We have dedicated R&D team, QA team, and QC team, along with the custom manufacturing support we are also getting from our production and laboratory team. Along with that, our product capability to extend in last 7 years. So earlier we are having started with the 10 products until now total 142 products we are dealing right now in development or validation stages. Next. We are having around 15 countries for the customer basis, in which major we are targeting the Europe, Brazil, China, Japan, Russia, and Middle East. 21 drug master file has been filed by the company till the date, along with the global approval from Anvisa and PMDA. Though considering that the financial part in last 3 years, we have the contribution from the domestic in last year around 96%, and export was just started for with the regulatory approval, which was 3.2% last year. And revenue from operation last year we have closed with the 120.2 CR. Next. So these are the details from our top 10 customers revenue. Last year we are having around 77% revenue from our top 10 customers and 22.3% revenue from rest all of the thing. So it was the more or less similar in the last 3 years considering the top 10 customers revenue. In FY25, we have manufactured totally 338 metric ton of API and intermediate mixture, and we have served to more than 38 customers. Next. So this is the detail for the Indian pharmaceutical industry, which is expected to rise at the from 2025 to 2035 at the value of totally 7,327 billion Indian rupees. Considering the different scope of the products, mainly in nutraceutical, personal care product, along with the cosmetic and some of the penetration for health insurance product like the generic medicine. So trade export, which next trade export and imports, considering foreign investment FDI policy. So key market for any for, finished dosage manufacturer should be US and UK, and remaining market is US market is more than 40%, and rest is around 49%. So we are planning to manufacture the API in which we are not having the any dependency, and we are for any raw materials. So our basic technology development, process development is work like that. We are fully backward integrated manufacturer, and with all the in-house technology development. Next. So this is the peer comparison with the Knox Laboratory, Acutas Chemical, which was earlier known as Ami Organic, and Supriya Life Science. So these all are the more or less similar kind of business in API and intermediates. Next. So consider now come back on the financial part. The key KPIs, the return on equity is in FY25 is around 25.51%. Return on capital employed in FY25 is 29.93%. Debt equity ratio was 0.73 in FY25. Debt service coverage ratio is 2.78 times in FY25. Current ratio is 2.64 in FY24. Receivable turnover ratio is 2.12 in FY25. EPS is rupees 6.38 in FY25, and net asset value is around 20.18 in FY25. Next. This is the P&L for last 3 years. Last year, company has closed the sales for total revenue is around 120.45 CR with the EBITDA of 32.3 CR and PAT of 20.51 CR. So these are the last year we have around EBITDA of 26.8% with the PAT of 17.06%. Next. So as per the balance sheet, FY25, so total asset was around hello. FY25, so total asset was around 81.2 CR. Next. So cash flow. So in last 3 years, FY25, we are having the cash flow of around minus 22.5 CR. FY24, it was 3.2 CR, and FY23, it was 2.8 CR. Next. So Anlon Healthcare is basically developing the technologies in which our main product portfolio, the ketoprofen, dexketoprofen, and loxoprofen, we are one of the best technology till the date around the globally, and we are the most competitive supplier to any innovator and any customer all over the world. For loxoprofen, we are working with one of the innovator in Japan, and for dexketoprofen, same we are working with the innovator based in the Italy. So we are the only Indian manufacturer supplier or first generic API supplier to Brazil for the loxoprofen after innovator. Our planning for the after IPO of this proceed for the further expansion to extend our capacity for ketoprofen, dexketoprofen, and some of the new high value molecule in which company is expecting the high profitability along with the better revenue. Yeah, I think regarding the issue and all those things, I'll hand over to the BRLM, Miss Jenny.
Thank you, sir. So I'm just repeating the issue highlights. Our fresh issue, we are coming up with a fresh issue of up to 1 crore 33 lakh equity share with a face value of rupees 10 each. And our issue size at the upper price band is 121.03 crore. And our IPO price band is 86 to 91 per shares. Our lot size is 164 equity shares. And our issue period is for anchor bidding. Issue is opening on 25th August 2025, and the issue opens on 26th August 2025, and issue closing on 29th August 2025. So our pre-issue shares is 3 crore 98 lakh 51,500 equity shares, and our post-issue capital will be 5 crore 31 lakh 51,500 equity share. So post-issue implied market cap will be 483.68 crore at upper price band. So our pre-issue holding of our promoter and promoter group will be 2 crore 80 lakh equity share, which constitutes 70.26% of our pre-issue capital. And our public shareholder will be 1 crore 18 lakh 51,500 equity share, which constitute 29.74%. Our post-issue holding of our promoter and promoter group will be 2 crore 80 lakh equity share, which constitute 52.68% of our post-issue capital, and our public will be 2 crore 51 lakh 51,500 equity share, which constitute 47.32% of our post-issue capital. Our company is going to be listing on NSE and BSE platform. Next, our object of the issue, our fund will be utilized for funding capital expenditure requirement for the proposed expansion will be 3071.95 lakh, and other than that, full or part repayment or prepayment of outstanding secure borrowing will be 500 lakh. Funding the net working capital requirement will be 315 lakhs. Uh, thank you, everyone. I think we should proceed with the questions.
Yes, thank you, Jenny ma'am. Thank you, Puneet sir. I
Yeah,
request all the participants to post their questions in the comment box. So first question is from Mr. Yash Mistry. Anlon is among the few Indian producers of propane sodium dehydrate. How strategically important is this niche?
Yes, so basically, generally what happen, mostly painkillers or non-steroidal anti-inflammatory drugs, we all Indian are used to for the ibuprofen, where in other part of the world depends on the biology of the other people. Mostly world developed nations are taking the either ketoprofen, dexketoprofen, or loxoprofen. Specifically in Eastern countries and Latam, loxoprofen is one of the biggest consumed NSM non-steroidal anti-inflammatory drugs, and we have the opportunity to work with the innovator Daiichi Sankyo as the first Indian manufacturer who is registered their product in Japan and Brazil. So we are expecting that this product is going to be replace the ibuprofen wherever it is going to use, and we'll have the first opportunity as a generic launch of the loxoprofen in the eastern and the Latin market.
Okay.
So
Next question.
yeah,
Yes, sir. Please continue.
yeah, Vaishnavi, I am done.
Okay. Next question is from Sudarshana. What are the company's core strengths that differentiate it from other Indian API and intermediate manufacturers?
See, basically, we believe that we are having the strong in-house backward integrated product manufacturing capacity. So we don't have the any dependency on the any import raw material, and along with that, we have the manufacturing facility to serve in the globally any countries which can allow us with the our capacities site approval with mostly all regulatory agencies. So regarding the intermediate manufacturing, we are having the opportunity to work with so many innovators along with the, some of the biggest generic manufacturers all over the Europe and eastern part, it's like China, Korea, and Japan. So that is differentiate to us from the most of the Indian manufacturer.
Okay. Next question. Tanish Shinde. The company operates with strong regulatory approvals. How has this shaped credibility with global clients?
See, we are working with the innovators. It's one of the credibility for the any API manufacturer, because unless and until the site documentation part, quality part, approval, regulatory is not there, none of the innovator is taking that much big risk to work with you. So we believe that we are having the credibility to work with the global clients is itself proven by we as we are working with the two or three innovator companies.
Okay. Next question. Sudeep Shastri. With 142 products across multiple therapeutic categories, how do you prioritize which segment to scale further?
See, basically, 142 products are in our product portfolio. Out of that, 65 product is still at the commercial. So, in pharma industry, the development, product selection, product optimization is continuous process. But considering the global situation and demand, out of that, hardly 8 or 10 product is going regularly. Apart from that, other products can go like the campaign basis or as and when customer requirement will be there. So out of 142 products, currently we are focusing mainly of main of our key product in which there is a possibility to become world largest manufacturer for some of them product like ketoprofen, dexketoprofen, and loxoprofen. So that we are planning, and apart from the new expansion, what we are planning, that is for our existing product, which is giving us, which will give us the upper end considering the other competitor from the either China or Europe.
Okay. Next question. Unlimited. The manufacturing facility utilization increased to 84.41% in FY25. What is the optimal utilization level you are targeting?
See, 100% utilization is practically not possible. So right now, what we have achieved 85%, that is the I think maximum one, because considering 85 to 86% is the optimum one. So now, if we want to increase the capacity, then we have to go for the further expansion.
Okay. Next question. Shruti Taure, how do you balance focus between APIs, intermediates, nutraceutical APIs, and personal care products?
See, as I have mentioned that we are working with the backward integrated products. So whatever the APIs we are manufacturing, their backward integrated raw material or key starting material KSM we are doing in house. So that is automatically part of the our product list. Now the nutraceutical category, which is emerged in last 2 3 years post COVID. So we have entered this one, and I think we are having best capacity for the pharma grade the nutraceutical APIs, and we are one of the leading manufacturer for nutraceutical API who is supplying to India's one of the biggest nutraceutical manufacturer. For personal care products, we are working with one Japanese company for their cosmetic formulation, and we have approved till the date 3 products to them. So our main focus is for either pharma or Nutra along with the cosmetic material as on and the opportunity will come.
Next question. Arjun Verma, top 10 customers contribute 78% of revenues. How are you working to de-risk this concentration?
I think it is the normal for the any API manufacturer. It is not like the that we are working with so many customers, because as we are working as a API manufacturer, our product is going in the bulk load, and it is highly entry restricted business. It is not easy to approve your product or API to so many customer at a time. So 10 customers contribution 70% is in generally pharmaceutical industry, it is within the range. So we don't think it is any risk factor, but ultimately it can give us the benefit that it is not possible for other manufacturer to enter in the same product line where there is no need of alternate vendor development. So we believe that it is not actually a risk, but it is showing the stability. In last 3 years, that our top 10 customer revenue contribution is more or less in the same line.
Okay. Next. Shreya Desai, what percentage of revenue contribution is expected from custom manufacturing of complex compounds over the next few years?
I think that will be around 20 to 22% we are expecting on basis of the project what we are right now validation going in our pilot lab for the validation or further development at the laboratory scale. So we are expecting around 20 to 25%.
Okay. Next question. Nikhil, debt level has reduced from 5,818 lakhs in financial year 23 to 3,836 lakhs in financial year 25. How much further de- deleveraging do you target?
Out of the issue proceed, we are planning to repay the term loan of around 5 CR, and we would like to plan to reduce our debt at least 40% in next 3 to 4 years.
Okay. Next question. Vedant Shetty, can you comment on the cash flow trends where operating cash flows turned negative in FY25?
Yeah, see, basically it was just due to there was some incident happened along with one of our key distributor who was unfortunately expired in the road accident, and now because of that there was a fund was blocked over there in last year, but it is now within this last month we have recovered almost 30% out of that, and we are expecting by end of this financial year fully recovered and cash flow will get positive by end of this financial year.
Okay. Next question. Google, ROE at 40% and ROCE at 22% are strong. How sustainable are these levels?
We are trying to keep our profit and sales at the rate of CAGR around 25% every year. So we believe that this ROE and ROS will try to keep in next upcoming years also.
Okay. Next, Deepika Chadda. FY25 revenues rose to 12,028.66 lakhs with EBITDA of
We are having the some of the product in our portfolio which is sharing the profit contribution more than 35 to 40%. So just because of the our process optimization, cost cutting of the product raw material cost, which give us the better EBITDA and profitability in FY25 with the revenue of 120.28 CR.
Chirag Panchal. Which are the top three focus areas for Anlon over next 3 to 5 years?
Yeah, we are mainly focusing on the nutraceutical product like the amino acids. Another one we are targeting to penetrate our existing product in which we want to plan to become at least to get 50 to 60% market share for the API in ketoprofen, dexketoprofen, and loxoprofen. And third area we are planning to work is the basically cosmetic or industrial chemicals.
Okay. Next question. Shantanu. The company's portfolio has expanded from 10 products in FY18 to 65 in FY25. What factors enable this rapid scale up?
It is either from 2018 to 2025 in 7 years. We have very strong R&D laboratories team, and we have the people who are aggressively working for the development of the any product. So by that team and all those support from our chemistry part and our commercial team for the production, we are able to develop the 65 product commercially in that 7 years. So that will come around annually 7 to 8 product a year we have developed. So I think that this is not a big thing, but out of that, we have able to file the 21 DMF also in last 7 years, which is showing our capability and capacity for development of the new product as per the regulatory standard also.
Okay. Next question. Shankar Verma. How do you plan to build resilience against regulatory, environmental, or supply chain disruptions?
See, regulatory part, we are having the in-house RA team, QA team, who is sufficient enough to tackle the any regulatory audit or any regulatory guidelines compliances for EHS environment part, health and safety part. We are having in-house all these policies, and we are zero liquid discharge facility. So we are trying to keep almost all these liquid discharge within the treatment within the facility, and there is no effect on the environmental part which can give us the any limitation for manufacturing of our product. And regarding the supply chain, we are not having dependency as of now for any of our raw material or KSM on any import part. So we think we are right now in the right direction with the right capability to avoid the disruption in regulatory environment and supply chain.
Okay. Next question. Sai Arora. Could you elaborate on the role of your four in-house R&D units and product development and customer retention?
See, our R&D labs are working basically from the molecules which is either decided by our marketing team or our existing customer who are planning to do either on the CDMO or CMO model basis. So, firstly, all this literature, route of synthesis, paper ghosting, everything can be done by the R&D teams. Then, basically, trial and gram level development is done by R&D. Then, our pilot team will take up the product from the R&D to pilot scale, in which the unit operation and engineering aspect can be cleared, and then ultimately validation batches and commercial batches has been trialed in the production area. Along with that, regular update with the customer, their quality requirement as per their required specification, and their method of analysis is taken care by our QC QA team. In our RA is taking care for all these regulatory document as per the requirement of respective FDA of the regulatory agencies.
Okay. Next question. Rishi, how do you view your competitive advantage in terms of customer approval cycles and DMF filings?
See, till the date, we have filed the DMF in around more than 10 or 12 countries. So, we are well aware about the regulatory guideline requirement, considering the document part, the quality part, the audit requirement, facility, hardware, and system requirement. So, our team is well sufficient enough to take care for all these regulatory approval and approval cycle, considering if we are considering the 0 days for the starting of the development of any product, then it is around minimum 3 to 4 years for the registration of any DMF, and approval will take around 6 to 8 months. So you can say around 4 to 4.5 month year 4.5 year time is required to register any single product.
Okay. Next question. Rajesh Bhatia. India's API market is projected to grow at 37.7% CAGR. Where does Anlon fit within this broader growth story?
Yes, Anlon is very well fit with the India's API strategy. What government is planning for making India, and we are trying to make our APIs for the global innovator and customers in the regulatory market. So we believe that the projected CAGR 30.7 is well achieved by Anlon also, and will comply with the that criteria with all these standards.
Rohan Jha, expansion of 700 MTPA capacity is planned. When will this be operational and what impact will it have on revenue?
We are planning to start that new expansion immediately after this IPO proceed will be there, and we are expecting around 14 to 16 months for operational of the new expanded facility. And once it is done, then we are expecting the revenue mostly more than the double what we are having in FY25.
Okay. Next question. Chirag Panchal. Beyond pharmaceuticals, do you see nutraceuticals, personal care, or veterinary products becoming significant revenue streams?
Yes, that is for sure. We believe that nutraceutical will be the new category, which is right now growing more than the pharma API and intermediates business, and we are closely looking on that, and we are developing the product according to that, in which we can be have the first more advantage, at least for the domestic market.
Next question. Do you foresee higher growth for domestic markets, 97% share in financial year 25, or exports currently only 3%?
Yeah, that was because of the registration and approval was pending for the exporting of our commercial product. This year we are expecting around 30 to 35% export revenue, and 60-65% domestic revenue, which will be again increase. Export revenue will be again increase in FY 27-28, which can be more than 50% in FY 27-28.
Okay. Next question. Sadika Naram. What is your strategy to penetrate regulated markets like US and EU where DMFs are in process?
Yeah, we are already registered in the EU. Our DMFs are already registered in the EU, US is market is already under the process, and we are expecting by next year we'll have the US FDA site audit or confirmation on that. So that both things are is already in process, and EU is already done, and we are expecting the commercialization by last quarter of this financial year.
Next question. Vedant Shetty, how do government schemes like PLI or APIs impact your expansion strategy?
See, basically, PLI schemes are for the product which is not getting manufactured in India, and in which India is having the major dependency on import. But in our product, in our case, our product line is completely niche, and we are not having any import dependency. So PLI for the API is not that much effective to us in our expansion strategy, because government
Okay.
has
Next
fixed the
question.
list.
And yes, sir, please continue.
Yeah, yeah. So I'm just telling in line of that, government has fixed the list of the APIs and intermediate in which Indian manufacturers are mostly importing from China. That is still the same after PLI scheme also. But in our case, we are not importing the any of our KSM or raw material, and we are fully backward integrated. So everything is either in-house or either on the contract manufacturing side. So this is not that this will not have that much impact, and import dependency or China remains high in some category like anti-cancer and antibiotic product, but that is not posing any risk to Enlon when we are not looking that like the opportunity also, because we are not having any direct or indirect relation with the Chinese import.
Next question, Charan Chaudhary. With 500 lakh allocated for your debt repayment, what post-issue debt equity ratio do you expect?
I think currently we are having 0.73, but after this 5 CR payment, uh, it should be somewhere around 0.65 to 0.7.
Okay. Prathamesh Gandhi. Are there risks of price volatility in raw materials affecting margins and how are they hedged?
See, generally, our working, mostly the price of the our product is not on the regular price fluctuation of raw material. We are working with some fixed price, at least for a fixed order. If any price fluctuation which is affected more than 10% in our raw material cost, then only we have to either increase or decrease the price. So basically, we are not doing that kind of hedging, but our price to our customer is more or less at par with the level that price fluctuation, daily routine price fluctuation cannot affect on that much on our profitability, because we have enough gross margin in our product which cannot affect on the raw material cost.
Okay, next question. Devan Shah. What are the targets for getting cash flow positive?
So we have some of the products in pipeline in which we are having the better profitability. Then we are trying to reduce our credit times from 90 days to little bit lower, around 40-45 days. And whatever the payments which is receivable more than 6 months, that we are trying to close it within this financial year. So we are planning that our cash flow will be improved, means noticeable by end of this financial year.
Okay, next question. Nikunj Patil. What therapeutic categories within APIs are expected to see that fastest growth in India and globally?
See, in India, as per the Department of Pharmaceutical data, I'm not having the exact year with me, but Indian pain management market is around 45 to 50%, and remaining market is mostly divided in cardiac, diabetic, and cancer. And others are in the very small amount. So what the category we are having with is pain management, this anti-inflammatory drug is having the better growth in the market, and I think the in India that anti-cancer will be the one of the biggest high-growing market for the API manufacturer, and same as globally.
Okay. Next question. Praveen Chaudhary, working capital requirement funding of 4315 lakh is significant. What scale of growth is this need to support?
As we are trying to growth means we are planning to expand the manufacturing facility and we are planning to double down our production capacity. So working capital requirement of 43.1 CR is like considered as to be at par with our production capacity and our revenue, which is expected in FY 27-28 somewhere around 300 CR. This 30.72 CR allocation is for the plant and machinery only. It is not for the considering the specific project, because the facility what we are planning to manufacturing it is multi-purpose plant only. So that is allocated for the plant machinery and building.
Okay. Next question. Sadhika Narang, how do you plan to balance between high volume APIs and niche high value products?
So right now we are planning at least 60 or 65% revenue from the continuity and our stable product, which is the high volume in which we are having the reasonable margin, but we are having some of the niche product in which we are having the better profitability, which will be around 30 to 35%. That can be considered as a better and stable product mix.
Okay. Next question. Devin Shah, with the further expansion to 1100 MTA, what is future trajectory of reaching maximum utilization of that capacity and how will it also affect cash flow and revenue?
See, basically the capacity 1100 metric ton per year, that what is targeting is on basis of the projection or product mix what we have right now along with us with the customers confirmed project. But if we are planning, then we can go up to 85 to 86% optimum level. 100% is practically not possible. And once we'll reach at the level of optimum level, then our cash flow and revenue, what is right now expected is around 300 plus CR year revenue, and cash flow would be, I think, always not an issue after getting that working capital of around 42 CR in the IPO proceed.
Okay. Next question. Nikunj Patil, how does the company manage compliance across 15 plus countries where it exports?
See, basically, if we are having the LATAM's Anvisa approval, and which is a Brazilian authority, then if we need to sell any of our product in Mexico, Chile, Colombia, or any other Venezuela countries in the LATAM, that on basis of approval, site approval of the Anvisa, there is no further requirement of site audit or anything. On just basis of our DMF and other documental part, we can do the export to that countries. In same way we are having the other countries in Middle East also, that Egypt, Turkey, Iran, then Saudi, Lebanon, Syria, where if we are having the CEP which is issued by the EDQM EU European Union, then it would be easy, and there is on the basis of CEP or EDQM approval, we don't have any site approval from the any of these countries. So considering that we are having more than 15 countries right now where we have developed the customer, and export is already started over there.
Okay. Next question. How are you preparing for stricter ESG and sustainability requirements from global customers?
See, most of the case, our customers are product driven. Plus, on the basis of the every year they are doing their QA or QC team is doing the site audit, the products documentation for the product what we have supplied. So, in any case, we have to be very conscious on the part of the regulatory and quality part, which is making us the already. Aware for all these things. So sustainability for the requirement of global customer is we believe that our regular practice and it will not impact that much to us on making the more stricter ESG part.
Okay. Next question. Astik Kumar, what's your view on inorganic opportunities? Are acquisitions part of the roadmap?
We have some of the inorganic opportunities for the acquisition of the factories where we are right now doing our backward integration, but company has not planned immediately now. So that will be decided later or when any better opportunity will come.
Okay. Next question. Nitisha, can you give us difference in margin profile from export and from India sales?
See, in generally, whatever the products we are supplying to domestic customer, in which we are mainly working with the gross margin of 30 to 35%, but where it's in the case of export or any regulatory market, it would be around 45 to 50% gross margin from the raw material cost and selling price.
Okay. Next question. Nikunj Patil, how does the company plan to manage geographical concentration risk of operating from a single manufacturing facility in Rajkot, Gujarat?
See, nowadays, for manufacturing of any API or any intermediate, or basically for any chemical plant, there is not possible to get any approval from Pollution Control Board without having the zero liquid discharge facility. So, being a company in Rajkot, which is not in the geographically concentrated area like Baroda, Ankleshwar, Panoli, Vapi, but nowadays there are so many API manufacturer in outskirt of the Rajkot and Morbis also, and we are not facing that much challenge to manage the company in the Rajkot itself. We are having the enough manpower in terms of production, QC, QA, and RA both.
Okay. Next question. Since the company has incurred losses in past, for example, financial year 2022, what measures are being taken to ensure sustainable profitability in the future?
Yeah, company has made the loss in FY22, but after that our product line was improved. We have discontinued the product in which the continuity was not there, even though the profitability was high. So company has selected such a product with the continuity, even though the profitability is compromised. But we are having the stable business, and after that we are having optimization of our product, and in which we have increased the profitability in terms of development and improvement of the our manufacturing process, and that will going to take care for our future product as well.
Okay. So I think we have covered. Okay, there's one more question. Amardeep Dosanjh. With a debt equity ratio higher than listed peers, how does the company plan to reduce financial leverage and manage associated funding risks?
Yeah, basically the right now this debt equity ratio is 0.73. I think it is almost in line with the peers, and we are still trying to repay our term loan whatever from the IPO proceed, and will try to improve that debt equity ratio.
Okay. Next question. What is long-term EBITDA margin range you are targeting post-expansion?
That would be EBITDA would be around 27 to 33%.
Okay. Next, Sudeep Shastri, very well presented. Thank you. Shantanu, thanks for answering my questions. All the best. Sir, I think we have covered majority of the questions. Thank you, everyone. Thank you, Puneet sir. Thank you, Mayur sir, and thank you, Jenny ma'am. All the best for the IPO. Thank
Thank
you.
you. Thank you, everyone.
Thank you.